Welcome back to Teach Me Money. If you've ever dreamed of building passive income, understanding dividends is key. In this video, we'll dive into the 5 types of dividends you need to know, each one offering unique benefits and risks for your portfolio. By the end of this video, you'll have a clear understanding of how to choose the best dividend types to match your financial goals. So, let's start with a quick overview of dividends in general, and why they're essential for long-term wealth building. Dividends. Before we dive into the specifics, let's make sure we understand what dividends are. A dividend is a payment made by a corporation to its shareholders, typically out of profits. It's a way for companies to reward their investors for holding onto their stock. But not all dividends are created equal. Some companies pay regular, fixed dividends, while others might offer variable payouts based on performance. In this section, we'll break down the fundamental mechanics of dividends and why they're a crucial part of many investment strategies. The 5 types of dividends you need to know. 1. Cash dividends. Let's start with the most common type, cash dividends. Cash dividends are typically the easiest to understand. They're exactly what they sound like. Companies distribute cash directly to shareholders. Cash dividends are typically paid on a quarterly basis, but some companies may pay them annually or semi-annually. The amount you receive depends on the number of shares you own and the company's dividend rate. Cash dividends are popular because they provide immediate returns to investors, especially those who depend on their investments for income, like retirees. But not every company pays them. Many growth companies, especially in the tech sector, prefer to reinvest profits rather than paying them out. Key considerations: how to calculate cash dividends when companies tend to issue cash dividends. The impact of dividend yield and payout ratio. Examples of companies that pay cash dividends. 2. Stock dividends. Next, we have stock dividends. Unlike cash dividends, stock dividends are issued as additional shares of stock. Let's break it down. If you hold 100 shares of a company that declares a 10% stock dividend, you'll receive 10 more shares. The primary benefit of stock dividends is that they allow investors to increase their holdings without needing to purchase additional shares. Stock dividends are common in growth-oriented companies that may want to retain cash to reinvest in the business. While you won't receive cash, your investment can grow through the increased number of shares. Key considerations: the pros and cons of stock dividends. How stock dividends affect the share price. Companies known for paying stock dividends, such as Tesla. The importance of compounding returns with stock dividends. 3. Special dividends. Special dividends are one-time payouts that companies issue outside of their regular dividend schedule. These dividends are typically the result of exceptional profits or a major event like the sale of an asset. For example, a company might issue a special dividend if it's been sitting on large cash reserves or if it's sold a key part of its business. Special dividends can be quite lucrative for shareholders, but they're not predictable. It's important to note that they don't necessarily represent the ongoing financial health of a company. If you're relying on dividends for income, special dividends might be a bonus, but they should never be counted on as a primary income source. Key considerations: how special dividends differ from regular dividends, the timing of special dividends and their potential impact on stock price, how to assess whether a special dividend is sustainable. Examples of companies issuing special dividends, such as Microsoft and Apple. 4. Preferred dividends. Let's now talk about preferred dividends. These dividends are paid to holders of preferred stock, which is a type of stock that generally gives investors a higher claim on assets and earnings than common stockholders. Preferred dividends are typically fixed, meaning the amount is set ahead of time and doesn't change unless the company decides to adjust it. Preferred dividends tend to be more stable compared to common stock dividends, making them a great option for income-focused investors. However, there's a trade-off. While preferred stockholders have priority over common stockholders when it comes to dividends, they usually don't have voting rights in the company. Key considerations: the difference between preferred stock and common stock, why preferred dividends are more predictable, the risk-reward profile of preferred stock, companies known for paying preferred dividends, such as banks and utilities. 5. Dividend Reinvestment Plan, DRIP, dividends. Finally, let's look at Dividend Reinvestment Plan, DRIP, dividends. DRIPs allow shareholders to reinvest their dividends back into the company, usually at a discounted price and without paying commission fees. Essentially, instead of receiving a cash payment, you get more shares of the company, which can enhance the power of compounding. This type of dividend can be an excellent strategy for long-term wealth accumulation, particularly if you're not in need of immediate cash flow. Over time, DRIPs can significantly increase the size of your investment, especially if the company is consistently growing and increasing dividends. Key considerations: how DRIPs can boost long-term returns, companies that offer DRIPs to shareholders, the benefits of automatic reinvestment versus taking cash, how to set up and use a DRIP effectively. Conclusion. So there you have it, the 5 types of dividends you need to know: cash dividends, stock dividends, special dividends, preferred dividends, and dividend reinvestment plan, DRIP, dividends. Each of these has its unique advantages, and understanding them will allow you to tailor your portfolio to your financial goals. Whether you're looking for immediate income or long-term growth, there's a dividend strategy that fits your needs. As you begin to build your investment portfolio, remember that it's not just about the type of dividend, but about strategic allocation. Diversifying across these different dividend types will help you balance risk and reward, ensuring a more stable financial future. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon to get notified about future videos. Leave any questions or thoughts about dividends in the comments. I'd love to hear from you. See you in the next video.